Hello, investors and traders. This is a video done late at night on Wednesday. What this video will specifically do, and the next few upcoming videos, will be building a case for a bullish stock market for the next 3 months, starting sometime in September or the beginning of October. We're going to tell you what to look for and when the time is right to buy the dip. But also, I am going to give you a warning for next year. The next few weeks will be very challenging. Expect them to be tough and a high volatility. Many investors are likely to sell out due to fear, uncertainty, and doubt and panic driven by emotion. However, those who stay the course may find that the market reaches greater highs by the end of 2024, finishing very strong despite the immediate challenges. We've been consistently advising you over the past 2 years to buy on the dips, and that outlook remains unchanged. Think of being in the 9th inning of a baseball game or the 4th quarter of a football game. We are coming towards the end of this bull run. But for the last 2 years, every time bad news came out, we had a specific systematic game plan to buy in the dips, and we were greatly rewarded. But things will become more volatile. Don't get discouraged in the coming weeks when the market pulls back. When mainstream media suggests it's the end of the world and social media is abuzz with panic, stick to the plan. The end of the year is likely to be strong with the potential for new highs once more. While I won't always be bullish, in 2022, we were bearish, and those times will come again. I believe that even though the market might head lower in the short term, this isn't the time to bet against or short it. Instead, wait for specific indicators that show a loss of confidence among investors as the moment we could present a buying opportunity. Some people is always buy and hold. Hold for 10 years. Hold Intel. Hold GE. Hold NVIDIA. My approach is not that way. But for the last 2 years, it was pretty easy being a bull. And I think we will have substantial pullbacks in the next few weeks to give us at least one more chance to ride this bull market. There's considerable uncertainty in the market right now, with the presidential election, wars, and geopolitical tensions all contributing to the unease. I foresee one more catalyst that could drive the market lower, which could stir emotions even further. Additionally, we're entering a seasonally weaker part of the year. September has historically been a weak month for the stock market, also followed by a challenging start to October. While it might be tempting to buy at the end of October and hold for the next few months, a more sophisticated approach is needed just by giving us a certain date and saying to buy that date. Before we get started, here's a disclaimer. The information on our channel is for educational and informational purposes only and is not intended to be a substitute for professional financial advice. Always protect your capital and come up with your own system indicators and advice. Relying solely on any guru, YouTuber, financial analyst, or the stars is not enough. As you know, I do not sell anything. I do not do affiliate marketing. I do not have a Discord. The only reason I'm making this video is first and foremost to make myself a better trader. When you teach something and you speak something, you become considerably better. My second reason to do this is maybe to pay it forward a little bit. September is typically the worst month of the year for the stock market, but it could also be present one of the best opportunities to buy the dips, as October, November, December have historically been strong months. However, knowing when to buy the dip is crucial because buying too early can lead to losses. If the market sells off later in the month, it's not as simple as predicting a fall throughout the entire month of September. Timing is the key. Historically, stock tend to rise during the first 3 weeks of September, up to September 19th. The significant September sell-off usually doesn't start until the last week of the month. Now, we've seen a pretty bad month already started for September, and it's come inching back, but those inches to me are not significant gains. Not only that, we should not just be looking and saying it's a certain date and we should buy or sell, but we should be building a weight of evidence. So while September is often cited as the worst month for the stock market, the decline typically begins begins around September 20th. If we look at the calendar, the first 3 weeks of September are historical positive, with only the final week being negative. Unfortunately, the last week of September is often so red that it wipes out all the profits from the earlier week. Statistically, large cap stocks are better buys during the September sell-off compared to small caps. Successful investing requires a top-down approach, first looking at the overall market, the macro view, or the forest, and then focusing on the trees or the individual stocks. Even though the last week of September is typically the worst, we do not recommend shorting the market at the start of September or even September 19th or 20th. Sometimes due to the widespread knowledge of September decline, the sell-off happens earlier. Currently, even though the market is entering the oversold position, some indicators suggest that it could go lower. Therefore, I am waiting for a very high probability entry point into the market, not just a time, but a slam dunk opportunity to buy, a high probability to bet an amount of money because the probability that we're going upwards in October, November, and December. Just on a side note, on September 18th, just one day before the stock market historically tops out in September, the FOMC will begin their two-day press meeting where they are widely expected to lower interest rates. However, this rate is already priced into the market. The certainty of a rate cut is already there. What should be more concerning for many investors is what Jerome Powell will actually say on September 18th. His comments could potentially trigger a stock market crash because the market almost always tops out within 3 months of the Federal Reserve's first rate cut. With the first rate cut expected on September 18th, the historical data suggests the stock market tends to top out either 3 months before or after this event. After this peak, the market often experiences a 9-month sell-off, similar to what we observed in 2022. This has caused a significant concern that once the Federal Reserve cuts rates on September 18th, it could continue to trigger a prolonged sell-off. Therefore, the time frame around September 18th and 19th, 20th is critical, as we may see the market top out and then begin a decline over the following week to a week and a half. After the initial sell-off, a relief rally is expected, following a further decline next year. That said, this is the stock market, and what I've outlined does not have to come true or happen on the exact dates. However, as we look ahead to the next year, it seems increasingly likely that I will be building a bearish case. Remember the 9-month rule. After the Fed starts dropping rates, the market is usually lower. Also remember, the first year of a presidential election cycle after the election is usually poor. So at the beginning of the video, we're telling you we're building a bullish case. The bullish case is October, November, December, and beginning of January has historically been seasonally well. A lot of the uncertainties of the election will undoubtedly be over, and we will know who will be the president of the United States. As I spoke many times before, my opinions on who's better, Kamala or Trump, is irrelevant. What matters to you is what historically has happened during these times. I want to further build a bullish case. If you look at this chart here, in January 2023, we told you buy, crossing 284. And on each of the dips, we were telling you to buy more. Even about a month ago, when the Qs hit the 200-day moving average, we told you to buy. Nothing has changed. The only thing that has changed is it will become a little bit more volatile, this market, and we are ending the close of this bullish run. Can we squeeze out one more run to the upside before the inevitable downturn of the market and the switch to commodities will be our play? If historical tells us anything for the last 2 years, look at each time we had a sell-off on the Qs, on the Spider, on the Dow. Our only thing is we think we're going a little bit lower. This is a sentiment intermediate term indicator. And when this sentiment indicator goes to about 300 or 250, we will be buying in, compared with the put and call option of a 5-day average pullback ratio, which will give us extreme fear. I am looking to make sure that I have a high probability chance. And the actions of the last 2 days, even though they were up, were not up significantly enough to make me feel to add to my bullish positions. I also want to study the CCI, and I'm looking for the CCI for a high probability chance of going to minus 200 to really to back up the truck. I believe this will happen in the immediate future. All I'm saying is be a little patient before you buy right here and right now. Definitely do not shorten the market for a day trade or a swing trade. That's fighting the trend that we are in. And clearly the last 2 years, we are in an uptrend. And clearly it's very difficult to time the top of the market. So what I'm saying is we're in a seasonally great period of time. We've done this same move 40, 50 times, buying on the dips for the last 2 years. The only thing that has changed is the same plan keeps winning, and it will be over, just not yet. You need to build a system. You need to build your own indicators. You can start with the CCI and the probabilities of winning. We have 2 videos about the CCI that can give you a high probability chance of combining with other indicators. I appreciate you watching this video. You know the catchphrase: study it, analyze it, adapt it. Peace.